Hey everybody, welcome back to Everything Money. As always, we're analyzing stocks. It's Seth, Paul, and Mo. We welcome you into our channel. If this is the first time you visit us, congratulations. We love having you in. I bring your viewer questions, sort of normal person questions, to a couple of wealthy guys who trade a ton of money. And today we're talking about Cisco's. In this video, we're going to use our 8-pillar analysis, look at the financials of Cisco Systems, and separate their financials and the company that they are from the ticker price that you might be usually buying on. If you're out there just buying stocks based on a price that you see and hoping it goes up, maybe we'll shed some light on how to separate the two, company and ticker, and see if this is an over or undervalued company at the moment. Paul, you got fired up when we mentioned Cisco. Why do you love this company so much?
I got fired up in a good way because Cisco to me is one of the best examples of euphoria and thinking, oh, this won't happen. And when people say, hey, growth, it doesn't matter what price you pay. Let me show you this.
Go ahead.
In 2000, Cisco hit $80 a share, give or take.
Oh, wow, look at that.
This is the chart since then. It has not touched that price. But for those of you who think, oh, there's growth potential here, it'll still work itself out. Because here, so in 2000, this year they did $50 billion in revenue. Let's go back to 2000. They did $19 billion. So they've gone up by over 2.5 times, and their stock has gone only down. Their stock is still way lower. It's still $56 a share versus the 80 that it hit. So it's still over 30% lower than it was in 2000, 21 years later, and their revenue has gone up 2.5 times.
Here's an article from March 19th, 2000, Paul, $1 trillion. An analyst believes Cisco is headed that way, and there's no way it's going to stop. It sounds familiar today, right?
And people would have said analysts are smart, etc. So first off, guys, follow us on Instagram. It helps us out a lot. But secondly, this is what I mean when I say don't overpay for hype and growth. Look at this parabolic rise and this absolute crash. This is a year and a half later. A year and a half later, it was less than $15, $20 a share from 80. If I told you here the stock could fall by 80%, you'd be like, you're crazy, Paul.
This term, Paul, overpaying for growth, even as a normal person, it confused me for a while.
Well, let me ask this question. Is 30% growth a lot?
Yeah.
That's a lot of people would sit there and say that's so much growth, just pay whatever because it's growing.
Yes.
What about 40% growth? How do you pay more when you're willing to pay whatever price? You might be out there saying, I'm not just paying whatever for 30%. Yes, that is exactly what you're doing when you're riding this hype train. You're just paying whatever price is out there. If you don't understand the financials and the present value of all future cash flows is what you should pay for an investment.
So in essence, if you bought back then when everyone was telling you, you already, their growth is already priced in and you never actually got it.
Correct, because once they did grow, you're like, oh, well then I already paid for the growth. The growth happened. It just justified the price I paid. It didn't give you extra. Think about that. It's like if I was a minor league baseball player and they said to me, hey, we're going to pay you $40 million a year because you could be a $40 million a year player. All of a sudden I make it to the bigs, I become Mike Trout. Okay, I justified $40 million. Does that mean you pay me an extra $40 million? I'm making $80 million? Well, no, because you didn't justify it. Not justified at 80, I'm justified at 40, but you already paid me for that. So think about that for a little bit. I know it can seem counterintuitive. If that makes sense to you, keep watching, keep following us. If it doesn't make sense to you, there are other moron YouTubers out there that probably make way more sense to you, and I will see you in the food line. So when I'm handing you the food because I'm donating my time. So Cisco's market cap is $240 billion. The 5-year PE, 27.6. That's an X.
Smidge high.
We want it to be less than 22.5.
Yes.
Okay, so it's an X so far, but 5-year return on invested capital, we want it to be greater than 9%. 20%. That's expected from tech companies. They have very good ways of investing their capital. Now, Seth, one thing I do like.
Yeah, I never saw this dividend before.
Yeah, 2.6%. It's double the market.
Not bad.
And they only pay $6.2 billion out of their free cash flow.
But how do they pay for that, Paul?
Their free cash flow is $14 billion a year.
Yep.
So they can easily afford this dividend. Now, in my opinion, if the stock gets cheap enough, they should be buying back shares. But people love the dividend. Gives you a nice little warm and fuzzy thing inside. You're getting a check every quarter, et cetera. So far, one check, 1X.
Pillar number 3 is revenue growth over the past 5 years. I'm certain they're doing well, Paul.
Boring.
Oh, they're okay, not too bad. Oh, I see.
48 to 50 billion. It's nothing. And look at 10 years ago, 46. So what this means, guys, is you got to pay a lot less for the company. When you don't have the growth to justify a higher earnings multiple or free cash flow number, you just got to pay a lot less for the company. That's it. And you'll see in our stock analyzer tool later, you'll see my multiples of earnings and free cash flow will be a lot lower. Why? Because if a company is growing fast, you should pay more for it. If two companies make $10 a year, but one's going to grow 20% a year, one's going to grow 5% a year, you should pay more for the 20% a year growth.
We'll bring this growth number back when we hit our pillar number 8, where we're trying to determine our market cap. With a slow growing company, we want to slow down our forward thinking about what price we should be paying. So.
Absolutely.
Go ahead, Paul. This is now shares us. Oh, net income, right? Go ahead. Profit.
9.6 to 10.6. Check mark. Guys, it's a check mark, but again, very slow and consistent. I'm fine with that.
Shares outstanding. This is pillar number 5. We want them buying back shares.
5 billion to 4.22.
Oh, nice.
Check mark there. So they're buying back shares. They're giving you more ownership of the company as opposed to diluting you and hurting you as an investor.
If this resonates with you, looking at the financials of a company, you're probably kind of nerdy like me and Paul. More like Paul maybe. But you can have this software and Paul will tell you how to get it.
Guys, we created this software because our users requested it. We kept doing this analysis. They said, how do I get the software? So we made it. Our software includes an amazing mobile app that does everything the website does. 8 pillars, 30 years of financial data, all this stuff, including access to us and exclusive daily content, but most importantly, a Discord community with over 6,100 people have access to it, and you get all of this for a measly 87 cents a day. Our competitors are $199, $199, and $35. If you are serious about your financial future and investing, this is pennies to pay per day that will literally make you hundreds of thousands, if not millions, over the next 30 or 40 years by learning the right process. Sign up for it. Link below, everythingmoney.com or Patreon. You can sign up either way and get our software.
Pillar number 6 is their total current liabilities divided by their 5-year free cash flow, and we want this multiple under 5, Paul.
So it's not current liabilities, it's long-term liabilities.
Sorry about that, long-term, think about that.
So what we do here, guys, is we take their 5-year free cash flow, 14 billion, multiply it by 5. That's $70 billion. We want their long-term liabilities to be under this number. Why? Think about it this way. You and your neighbor make the exact same amount of money, have the exact same house, exact same cars, exact same family, but for some reason, they have $10 million in debt and you have 0. They are much more likely to go under and lose everything than you are. And that's the name of the game, is being conservative about your number. Yes, more debt means more leverage, which means more profit potential, but it also means the other way around. When the bad times hit, they will hurt the most. So we go to the balance sheet. We scroll all the way to the bottom. $30 billion. We want it to be less than 70. They have $30 billion. They can pay off all their long-term liabilities in a little over 2 years. That's incredible. That's awesome. I love it.
Pillar number 7 is free cash flow growth. This is very importante, Paul. You know that.
Muy importante.
Go ahead.
So we go to the cash flow statement. Cash from operations less your net capital expenditures. What this means is this is the money that's actually coming to us after investing back in the business. 12.9 billion, 14.76. Check mark there. 14 is our average. So what we're going to do here, guys, just to get a starting point of value, we multiply our 5-year free cash flow average by 20. So we take that 14 billion, multiply by 20, and we have $280 billion. The market cap is 234. So that's a check mark. Now, does that mean you go out and buy this company immediately?
Let me slow you down. So we kind of want the market cap. We think this company's valued at 280 bill. The actual market cap is 234, which is under. So we might be currently undervalued, Paul.
However,
go on.
If you remember, this company doesn't have a lot of growth. So after Mo does his charts, what we're going to do is we're going to put in our stock analyzer tool, then factor that growth in. This is a starting point for us. And we like the starting point. I'd rather have it be under than over, but we're going to put in our stock analyzer tool and make revenue growth assumptions to determine if that $280 billion value we come up with is reasonable or not.
Folks, here at Everything Money, we want our app to be in your hands, the software in your hands on a daily basis, and that community. We want this, Paul, our community, our Discord chat is a daily thing for all of us now. We go in, we chat, and if you're looking to trade this company in a faster pace, you can join Mo in the Bid and Ask Nation, that glorious Bid and Ask Nation. You know, I love you, those bid and askers. Mo, what are people doing in terms of trading this stock more quickly?
So I'm very zoomed into this. These are all-time highs. That's all we need to know. It's had an incredible run-up since COVID and whatnot. But right now, you can see that the trajectory is a downtrend. You can recognize that from my candles that have turned red. Now, just because something turns into a downtrend doesn't mean go and buy the stock. Or sell short the stock. What it means is the downtrend is there. Now let's get confirmation. The first day of the downtrend was Monday or Tuesday of this week when we had that big sell-off. Since then, it's been a little bit of snapback in price, meaning the stock price has moved up. So let's let this get down into the sweet spot, both lines into the sweet spot, and make a confirmation and then start making engulfing candlesticks down, because you're going to face a lot of support areas that have been created since the run-up of COVID. Now, let's just take a look over here. Look at this incredible amount of this is a lot of negative sentiment. that's probably 2 straight weeks of more selling volume than buying volume each day. So they have a lot going against them. So pay attention to this from a shorting perspective, but get confirmation before you go and execute the trade.
Paul, let's head over to the stock analyzer tool. You get this as part of our software, and you can start analyzing assumptions made for the future and what you should be paying for the stock itself.
Now, one thing I want to jump to real quick.
Look at that.
This is our 8 pillars tab. It skips all the steps for you. It shows you all the checks. The 5-year free cash flow is good. The only bad one we have here is the PE. But anyways, we go to the stock analyzer tool. Now, guys, I've made the decision to do a 7-year analysis and do my 3 assumptions. I actually went a little extreme. I sat there and said, let's say they lose 0.5% in revenue a year for the next 7 years. Let's say they break even, gain 0.5%. Not big numbers, but look at their last 10-year numbers. They're not very good.
Yeah, they're not going anywhere.
Here are my assumptions all across the board. I put a low PE in because low growth stock means low PE. I put in pretty reasonable assumptions on my return.
Yeah.
I hit the analyze button. This is bad. The stock's got to basically fall by half, essentially, to be worth it. And why? It's that growth number. There's no growth in this company. Even if I go change this middle, the growth number to 2% a year, let's see how much it changes things. Still, we're got to drop 30% here. We still got to drop over 30% to even be in this ballpark. So guys, love Cisco, love their financials, but they're just not growing revenue enough for me to really feel comfortable about it, where I sit there and say this is a good return on investment for me. Don't get swooped in too much by the dividend. Just be cautious and wait for a better time to buy Cisco. I think it'll appear at some point.
Yeah, that's what take. Join our community. You can join Mo Trading, and you can have Paul and I tickle your eardrums with value investing. Yeah, that's our take on Cisco. Thanks for watching. Fondle that thumbs up, and we will see you on our live streams, Mo in the morning at 9 a.m. Eastern. And we go live to the world, Paul, Tuesdays at 2 p.m. Eastern. Join us, and you can ask more questions. We'll answer them. That's our take. Everything money, baby. Thanks for watching.